So for the cost responsibility centers, there are three basic responsibilities. There are four, but they most of the textbooks state now they're saying only three. First is the cost center, which is responsible for the costs and expenses. So basically, everybody who has to make decisions about the cost is responsible for this kind of center. Obviously, don't keep people who are in the cost center responsible for anything else. Profit center. Now the manager here is responsible for the revenue expenses since you're getting the profit from the revenue expenses. And investment center is responsible for everything. Basically, investment center is the one who collect all the profits from the profit centers and then making decisions, should they invest, should they expand, should they shut down division, should they shut down the restaurant, what exactly should they do? For the investment center, you can think of about the headquarter of Starbucks, and the profit center will be every Starbucks location. So the responsibility is basically you evaluating managers based on the capacity of making decision and capacity of responsibility. And you only evaluating them on the cost that they can control. You're not evaluating them, you're not preparing the report, the cost that they cannot control. So that's for this cost center, we're gonna chase only the costs. Again, only controllable costs in that case. So when you're preparing the report, any manufacturing overhead cost, property taxes, and the salary of the manager should be part of the report. The common cost for the company should be excluded for those reports. For the profit centers, again, you including in the reports any revenue expenses that the manager can control. The direct fixed cost will be one, indirect fixed cost will be the other, that will be controlled, obviously the sales revenue. Only controllable cost. Now, once we're doing this profit center, on the profit center, we can use cost volume profit analysis, or we can do the contribution margin format statement in order to evaluate the performance of manager. How we're doing that? By dividing the cost on the variable and fixed cost. Once we divide on variable and fixed cost, you can come up with a contribution margin. After that, you can apply cost volume profit analysis. But in this case, we're going to we talk about a controllable contribution margin, which is the margin of the revenue less variable cost. And then we're going to have this controllable margin, which is contribution margin less controllable fixed cost. We're never going to include the common fixed cost in that report. It's going to look like this. So once you see contribution margin and you see that will be controllable contribution margin here for this. Let me make it bigger so you can see it. That will be here controllable contribution margin, and then we're going to add controllable fixed cost, and then we're going to have controllable total margin. You already answered to this question. This question, the answer was the division center is not the one of the responsibility center. And I believe we already answered this one. So let's move on to the investment center, which is more interesting for evaluation for reason of indicators that we're going to use to evaluate that center. First was return on investment. And as you remember from the formula in the classroom, the return on investment is calculated by getting the operating income divided by average operating assets. Now, since we evaluating here the investment center, we're going to go to the controllable margin versus the average operating assets. So basically from the activity and the cost that this particular center can control, how much return on investment they can produce from the operating assets that they have available. That's how we should interpret that number. And here, as you can see, after all the fixed costs are, if all the fixed costs are controlled by the manager, now the average operating assets for this particular division is $2 million. That's your budget here versus the actual results. And you can see on the budget side, you're projecting to generate 15% return on investment. But in reality, obviously, the biggest problem here with this number is that your sales going down. If the sales going down, obviously, your controllable margin is going to go down. So you can even see that $50,000 reduction in sales pretty much transferred directly to the bottom line. We're generating some favorable variances, but that's not because we actually saving. We don't know if we're saving or not. The only thing that I can say here is because of the drop of the sales, obviously, most likely we're selling less product. Is this report accurate? Obviously, it's not. What we have to do, we have to adjust the budget to the actual results and then run the variances and see where we are and compare where we are compared to where we're supposed to be based on the same level of activity. That's a normal thing, and I want you to be alert when you're evaluating the performance based on the reports prepared from the third parties. When you see a report prepared for the third party, please use a common now management accounting set of mind. And look, when you look at the report, question it, ask questions, try to find the logic, and if this logic makes sense. And then make a decisions, because it's very easy to make a decisions, very difficult to undo the decisions that you already make, which turn out to be the wrong decision. So alternative measure to measure that return on investment is valuation of the operating assets. So now, since we have in this formula operating assets, average operating assets, now the question is how we measure those assets. Are we using the book value, or are we using the original cost, or are we using the fair market value of those assets? And that's going to change the percentage. That's going to change everything. And the other thing is how we generating the controllable margin in this case, or operating income. What's on the expenses? How much expenses the accountant was able to accrue in that one? As you already know, the accountants are very powerful people, which using the very small tool to change the reports, which is called debit and credit. And if you don't understand debit and credit, you're never going to understand what's happened, what the accountants did. So anyway, with the magic of sales divided by sales to the return on investment, we were able to produce a new formula, which is profit margin times investment turnover equal to return on investment. If you want me to show you again how that's done, I can easily show you using one Excel spreadsheet. Just give me a second to do some adjustments here, and I can show you my Excel spreadsheet. For some reason, for those mathematical questions, I always prefer to see to do it on the Excel spreadsheet. Um, Probably because I'm a more visual person. The explanation in through the slides are not always helpful for me. If somebody explains, I want to see it. I want to understand how from where the things come from and why is the way it's sitting on the slides. So let's do it this here on this space here. I'm gonna make it a little wider. So again, return on investment. Our return on investment is equal to, let's make it nicer now, presentable and bigger. Can you guys see my screen?
Yes.
So the return on investment in this case is equal to, let's use the March store sales. Is equal to company operating income divided by average operating assets. That's the pure formula here for the return on investment. Now what we're gonna do, we're gonna grab this formula and we're gonna do some magic here. What was the magic? We're gonna do this, we're gonna say, how about if I do return on investment in operating income divided by average operating assets time 1. And what we ask is, when we do this, do we change the formula? Obviously, we don't change the formula. But on the other hand, we're going to say that that 1 here is equal to sales divided by sales. And if we do that, what's going to happen now? That's the biggest question. If I do this, what's going to happen? I can substitute in the previous formula, and instead of 1 now, I'm going to have here, I'm going to have sales divided by sales. So once I do that, now I can play with those numbers. What I'm going to do, I'm going to flip these cells to come here, and these cells to just going to play with the cells. So what I'm going to do, this cell is going to come here, and this operating income is going to come here. So insert. Let me show you with the shape what exactly we're doing. We're replacing those two. We're flipping those two. So our new formula, it's gonna be sales is gonna come here, operating assets, operating income is gonna come here. In the textbook, they're actually doing the opposite. They're playing with those two numbers. In the textbook, that's what they're doing. Let's flip it that way. So you're gonna have operating income divided by sales. For some reason, they're always going with this direction, so let's stay with that direction so it can be easily comparable for what you're doing. And then we're going to have sales divided by average operating assets. So now this whole thing, we're going to call it turnover margin, because all the operating income that you're generating from sales, that's your margin. And Sales divided by average operating assets, we're gonna call it turnover. Assets turnover. And now we have completely new formula. Now our return on investment is equal to margin time turnover. So now you know how we come up with this completely new formula, which is used for evaluation of investment center. And as I said in the classroom, so how we can affect how can we affect our return on investment? Well, in different ways. First, we can increase the sales. By increasing the sales, obviously our here the denominator is going to increase, but you have to understand the logic of all the changes that may happen here. For example, if operating income increase, return on investment is going to increase. If the sales increase, the return on investment, since that's a denominator, margin is going to go down, maybe. Depends, are we increasing the operating income in the same pattern that we're increasing the sales? If that happens, the margin is going to increase. On the other hand, if the sales increase here, now our numerator increasing. If the numerator increasing, the turnover is increasing. If the average operating assets decrease though,
बोलो
now the turnover also increasing. Why? Because the average operating assets in this case is our denominator. It's a simple math here. Denominator increase, reduce your number result.
Don't
Nominator,
मारो
was that for me or just for yourself? Anyway, if that's for me, yeah, just let me know. Can you guys hear me?
Yes, Professor.
Yes, Professor.
Yes.
Okay, so again, if the numerator increasing, obviously increase your result. If the denominator increasing, you're reducing your result. So that's very simple mathematical. There's nothing scary here. I'm not giving you anything new here.
બધા શું કરે છે
I don't get it.
બધા શું કરે છે
Still don't get it. Sorry. Okay, so let's move now, but let's go back to the slides.
Professor,
Yes.
could you give any example on return on investment?
Return on investment, yes, we can. Let's go with the here. With this question here. Let's go back to the Excel spreadsheet and we can do some examples. So we have this basic formula return. Let's go back to the basic formula return on investment equal to margin and turnover. And this is the information that we have. No, I don't want it this way. I want it this way. This is the information now that I'm gonna use. Let's move it here. So I can expand this one, expand that one, and go back to the normal outline of the row. Like this. This is my information now. What's happening here?
We can see your screen.
You cannot see it? Okay, let me. Oh, because I'm not sharing. I'm selfish now. But now you can see my screen. Can you? Sorry, Irina.
Yes.
Professor.
Yes, Professor.
Okay, so now what's happening now? We have sales, which we needed. What else we have? Average operating assets, which we also needed. What else we have? We have controllable margin, which we also needed. So here we're going to substitute operating income with the controllable margin, since this is the money that we can control. And let's see what we're going to have. So two ways to do it. First way, go to the basic formula. If you have that information, you can easily go to the basic formula. The very, very basic formula that we make. Right, from that formula, you can easily see that sales operating controllable margin in this case is 600,000. And your average operating assets are $5 million. Now the question is, how much is your return on investment? And you can easily see how much will be the return on investment. That will be equal to this one divided by that one. And we're going to put here that's a percentage, and we're going to see that's 12% out of the question. Our return on investment in this case. Right, we can easily see those things. Now, can we use the other formula? Yes, we can use the other formula as well. But for the other formula, we have to go to that extended format. So how that's going to look like? Well, in this case, we're going to have operating, and now we're playing with the controllable margin. Controllable margin here will be 600,000. Let me get those one. And paint. 600,000. My sales are 2 million. Or zero, $2 million. And then on the other side, I have my sales 2 million. 3, 1, 2, 3. And on the bottom, I have 5 million, which is my average operating assets. Those will be time. So where that's going to bring me? If I still applying the same thing, I'm going to have here this number divided by that number. That's going to give me my percentage. That's definitely percentage. And then I'm going to have time. I don't need to merge this. I'm going to have this number time divided by that number. 0.4. And that's a number here. That's not a percentage. The turnover, asset turnover, is not a percentage. It's a number. And once you get those two numbers, you can easily calculate how much is your return on investment, which return on investment in this case happened to be 30% times 0.4 should give you again 12%. So as you can see, it doesn't matter which direction you're going to use, which way to get the formula you're going to use, you're always going to come up with the same result. Either going to go directly with using operating income divided by average operating assets, or you're going to go with the margin turnover. You're going to get. But the only reason that we're going with the margin turnover is give you now more flexibility, more understanding what's going to happen if any of those changes. That's why we're moving to that extended format of the return on investment, so you can see different things, and you can see how you can increase the return on investment if you want to again. So let's go back to slides and see what the slide's suggesting here for the increase of the return on investment. And that was that one. So basically, if you increase by sales, so let's see those scenarios going one after another. This one is one, and then this one is the other one. Let me copy those one. Let's move now to the Excel spreadsheet and see how we're gonna deal with this situation. Now we have to go a little bit further. I have to share my screen. Sorry. Here we go. Once I share my screen, now you can see that now I can use those one. First scenario, increase sales by 25%. Okay, so where are our sales? The only thing that I don't like here is increasing sales by 25%. What exactly that means? Because if you increase your sales by 25%, that means you're increasing your variable cost with 25%. So that means that the only thing that's going to happen here is your contribution margin is going to increase with 25%. And since we know that the fixed costs are fixed cost, means that the fixed cost is going to stay the same. Do you understand my logic?
Yes.
Right? That's one thing that you should understand. Increasing sales with 25%, that's fine. So let's incorporate this one now. What we have, 25%. Let's see if we do that, are we gonna get exactly what we want? So what we need is original sales time in brackets 1 plus 25%. That's my new sales. Well, but that's not the new sales that they're showing in the calculation here, which they suggesting. That means the variable cost should increase with 25% and contribution margin should increase with 25%. So let's follow their logic and see if we're gonna achieve that one. One plus, oh, we directly have to increase our contribution margin. Let's see what's gonna happen now. Those two and those two are gonna give us this minus this one. We're gonna get the contribution margin 125 minus 300. Our controllable margin will be this one minus 300,000. It's gonna be 825. Now the question is the 825 increase with give us increase 25? She should be, but let's see, let's double check that one. So we have here 600,000 time bracket 1 plus 25. And let's see if that's, you see, that's where we're having a little bit how can I say, that would be more like a difference in numbers. So what they're doing in the slides is they're going directly to the increase of the controllable margin with 25% and then working backwards to get that increase. And how much is the actual increase in sales? How much is actually increase in the variable cost? Or rather than incorporating the 25% in the sales and 25% into the variable cost. That's why let's work with our numbers instead of 750. Let's work with our numbers and see if in our reality what's going to happen now. Let's work with this part and see what we're going to get. So what's happened? Our operating income went to 825. Our sales jumped to 250. That will still gonna be our sales. And our average operating assets, we haven't touched them, they're still 5 million. What's happened with the return on investment? Now we can see that increase with up to 17% out of 12. Used to be 12 on the original case when we increased the sales with 25%. That goes up. Now, what's going to happen if we decrease the variable cost with 10.72%? So I'm going to copy this here and I'm going to flip it right here. Before I do that, I want to change something. I want to do this. I want to lock this cell so I don't have to repeat it all over again. I'm going to lock this cell here and the rest is just formulas. What happened here? What happened here, people? I think I changed something. Now, equal this one, F4 times 1 plus 25. Okay. And this one is equal to this one, F4 times 1 plus 25. So that's what's going to happen here. Now, the next one, this is our calculation. That's how we get those 70%. So the next one, I'm still going to copy this original and going to flip it right here. And let's decrease only and only the variable cost. So that means sales are not increasing. There's no increase in sales with 25%. The sales will stay the same. So basically this one gone. We already covered it. So let's increase 10.72%. That will be percentage. 10.72. And decrease our variable and fixed cost. So the total cost going down with 10.72. So what's going to be? This one is going to be equal to this one minus, and bracket will be still going to be this number time that number. That will be first decrease. As you see, once we're decreasing the variable cost, our controllable margin jumped right away. So from 900,000 went to 1,070,000. And if we decrease the fixed cost as well with the same percentage, 300 minus, in bracket, we're going to get again 300 times 10.72. That will be another deduction. So as you can see now, controllable margin jumped from 600 to 750, 80. Is that how they're doing? 750, yeah. They're pretty much the same reality. So what's happened with our return on investment? Well, sales don't change in this case. Average operating assets don't change. So basically, whatever we're getting as a turnover, we're still getting a 0.4, but our margin increase just by reduction of the cost of 10%. That directly hits us on our operating income. And since the sales stays the same, our margin from 30% jumped to 38%. Our return on investment from 12% jumped with 3%. And then let's stop sharing this. Let's move to the slides again. The next scenario is what's going to happen if we reducing the average operating assets with 20%. So in this case, we're not touching the margin. Margin is going to stay exactly the same that originally was. Let's do this scenario so you can see it. What I have to do is I still have to copy this one first. And now to get the scenario from the slides. Now I'm reducing my average operating assets with 20%. So what's going to happen in that case? Well, my sales going to be the same, right? That sales is not going to change. That's going to be my original sales. Variable cost will be my original variable cost. My controllable margin will be the same. My controllable fixed cost is still going to be the same, 300,000. But my average operating assets going down with 20%. So that will be equal to 5 million that I have originally minus that's not minus, that is minus in bracket this one time 20%. So my turnover increasing. My margin hasn't changed, but my turnover increasing with 0.1. That gives me a raise to my return on investment from 12 to 15%. Now if you want to play further, what you can do is you can have different scenarios here. What if I increase my fixed expenses in terms of advertisement, and that increasing my sales? What will be the effect on the return on investment? And there will be different scenarios here that you can come up with if you want to. So for this one, for formula for calculating return on investment, we already saw, you already see that this answer is B and C, both of those formulas working. And this was the question that we tried to do in the classroom, which I asked you, and some of you did it. Actually, most of you did it. So we can do it together on the Excel spreadsheet. Let me copy this one. And now we can move to the Excel spreadsheet and try to do it on the Excel spreadsheet. So basically what I'm going to do, I'm going to work with the very first worksheet that we have. And once I have this worksheet, I can post the question right here or a little bit down. Well, it's going to be right here. So in this question, what we have, the newest division has reported to return on investment. They already reported to return on investment. They say, okay, my return on investment is 14%. With operating margin 250. So if we have to substitute in this formula, this is the formula that I want, that they have. So what they have a average, so return on investment is 14%. Actually, I don't need it. I don't need to be on merge. I can do it this way. And I have operating margin is equal to 250, 750. And that's a number here. Let's change it to number. Correct? That's what we have. Now, they have the target return on investment for the division was 16%. Now we have target return on investment. That's something new. How much they want? Well, they want 16%. If the operating assets cannot be changed in the short term, what does the margin have to be in order to reach the target return on investment? So what we're chasing? We're chasing this number. That's what we're doing. So how can we get this margin? First, we have it margin when we have 14%. So if I have 14%, once I have 14% return on investment, my margin is 250, 750. Now the question is, how much is my turnover? Well, obviously my turnover here will be equal to my margin divided. Here will be divided. What can I do? The divided probably is going to be divided like this. Divided by 14%. And once you do that, you can get that the turnover in this case should be equal to, let's continue on that line. This one divided by that one. Does that make sense?
Yes, Professor.
Okay, that's my turnover. But that's not my turnover. What I'm talking about here. Why don't you correct me, people? We're using the wrong formula here. Are we not? Operating margin, which is operating margin in this case. Operating margin, which is into the operating margin is a percentage, not a number. So once we see the number, all this doesn't make sense. So what we have to use? Let's get rid of this. We're playing with the basic simple formula here. That's where we are. This is the reality that we are. Once we're in with numbers, this is our formula. So in this case, we have a return on investment to be operating income is our operating margin. Average operating assets is the average operating assets. That's what they say, the average operating asset cannot be changed. So now we have to find out once my operating income is 14% and my operating margin is 250, 750 as a dollar amount, how much my average operating assets? Now when we get the result, that result's gonna make sense. You understand? Before that, when we were working with this formula, that doesn't make sense any. That doesn't make any sense. But now it makes sense. So where would be our number will be exactly the same, obviously, because we're gonna replace those 40% gonna go denominator, and average operating assets gonna become as a result. So in that case, our average operating assets. So basically, if I have to do this, what I can do is let's get rid of those. Okay. Gonna delete those ones because I don't like the way it is. So once we substitute in this formula, we're gonna have average operating assets to be equal to that number divided by 14%. And now in different reality. So now we can get this to be equal to this number divided by 14%. And now that number makes sense. That my average operating assets are that amount. And once I have my average operating assets, what can I do is go with the next one. Now what they want. Now they want 16%. Now the question here will be, if I want 16% and my average operating assets are that much, what will be the number of my operating income? Or in this case, operating margin. Make sense? Are you guys with me?
Yes.
So once we substitute in this formula, what we're gonna have? We're gonna have here operating income to be equal to what will be our nominator now? How are we gonna get the formula now? Any suggestions for the formula? Anyone? How can I come up with the formula, people?
It will be 16
So
times the million.
all right. Thank you, Irina. So in this case will be that number here. Or how are we gonna express by the numbers? By if we have to do the formulas here, that will be that number time 16%, correct?
Yes.
And what will be your result here now? Equal to this one time 16%. And we have to express this as a number and see which one is the closest one, and that's how you get your answer. Make sense? Since looks like a very difficult question, but totally solvable. The only thing that you have to play with the formulas and know some basic mathematical function, like a multiplication and so now let's go back to the slides and let's cover the next of the slides. So that was the return on investment. And we're getting the answer now. Now, another measurement for the performance of these people will be residual income. And as I said in the classroom, the residual income will be the income, actual income, compared to the income that you want to generate based on the required rate of return. Let's see how this is going to work. Let's imagine that this division has the following return on investment. They have controllable margin of $1 million and average operating assets of 5 million. So currently their return on investment is 20%. So to produce the product, operating assets increase to produce the product, consider producing the new product tracker. To produce the product, operating assets increase with 2 million. They're expecting to generate additional 260 controllable margin. So the question is 260 divided by 2 million is it going to be 20% or not? So controllable margin currently is $1 million. Controllable margin $1 million. Now, without, so we're generating 20% return on investment. If we're adding the new machine, the new product is going to generate 260,000 out of 2 million assets. So that's going to give us a return on investment 30%. If we combine those together with the new product, our return on investment is going to go down to 18%. Now, if the manager is evaluated on the current return on investment, question is he gonna invest? Is he gonna invest in this new product? What do you think? If I'm currently evaluated on 20% and the company expect on every new product that they start producing in the company, I should generate 20%. Would I invest in this opportunity here for this new product, which is going to decrease my return on investment to 18% by giving me only 13%? Do you think I'm going to invest?
No.
No. But if the company require minimum 10%, am I going to invest in that case? Now the product itself give me 13%. The company wants minimum 10%. In that case, am I going to invest?
Yes.
Yes. Why? Because I'm getting the 10% definitely. And company only wants 10%. Well, I'm generating 30%. They should give me a bonus. Make sense? So if I'm evaluated on the current return on investment that I'm generating, no, I shouldn't be investing in the new product. But if the company wants only 10%, I'll go for it. Why? Because I'm generating 3% more than what the company wants. So what will be the residual income? Residual income will be the actual income, actual return on investment compared to what the company wants. The simple calculation will be this. If the company wants 10%, they want $60,000. With the 30% that I'm generating, I'm going to generate more than $60,000. So, should I invest or should I not? Yes, I will invest in this project since the company only wants 60%. Now, that will be with the return on investment in this scenario, and the residual income in this scenario. Now, here, as you can see, the return division using $2 million to generate 260 residual income. Now, can the different division use the fewer operating assets to generate greater amount of the residual income? And let's see this. Now we're using $4 million to generate 460 of controllable margin. Now the residual, if you're using both investments are equal, so basically here if we're using this information, let's go with this information. I want to show you something. Here the slides are a little bit confusing. Sorry. Apologize for that. I need to do some explanation here so you can get the numbers. Get the idea. Let me go back to Excel spreadsheet and let's work with the Excel spreadsheet. So I'm going to start fresh on the new format. So what I'm going to use the first one as a template and I'm going to erase everything. And now we have a fresh. So this is our information that we get in here. Not perfect information, but let's work with it. I'm going to do some adjustments so you can get the idea. So this is the company that having those results. Now what we're missing here is how much are our average operating assets. They forgot to give us. So pretend here that average operating assets here are $2 million and here are $4 million. The required rate of return is here, required rate of return is 10%. I want here 10% and I want from these guys 10%. What that means that average return, so how much expecting for here return? What's the expected return here? Time 10%, right? And that will be a number here. I expect $200,000 of the first project and I expect $400,000 from the second project, correct? Are you guys with me?
Yes, Professor.
Now my controllable margin the controllable margin currently, my actual controllable margin, let's leave one space here. So this is what I want. This is what I get. Currently, I'm getting actual controllable margin is that much. The question is, how much is my residual income? Now, let's go required. My required return was 200 from the first project and 400,000 from the second project. So my residual income in this case is the actual minus what I want, 60,000 and 60,000 here. Does that make sense now? Do you understand now the question? So the company has two projects. Project one, let's go with project one, and they have project two. They decided in which of those projects they should invest. For the first one, they have to invest $2 million. In the second one, they have to invest $4 million. They want 10% minimum. Minimum I want 10%. So minimum, I want return from the first one, $200,000, and from the second one, I want $400,000. In reality, first one generate 260, second one generating 460. And since from the first one I want only 200, but he generate 260, my residual income is $60,000. So I'm getting $60,000 more than what I wanted. Make sense now? This is what I want. This is what I get. And in the second one, I wanted 400. I get 460. So I get again $60,000 more. The question is, which one is more profitable? If I have to, if I have to continue with only one of those, which one should I continue?
Project 1.
Sorry?
Project 1.
Project 1. Why?
In Project 1, investment of 2 million gives 60,000. Whereas in Project 2, double investment gives
No,
the same
listen.
amount.
It doesn't give us 60,000. It give us 260. Right? This is the actual. So it's not 60,000. 60,000 is the residual income, but in reality, producing 260. So if I have to calculate return on investment, how much will be the return on investment on the first one? What do you think? How can calculate the return on investment? Remember? Here, I'm going to help you. Return on investment, you can calculate it with this formula, which in this case is your controllable margin and average operating assets. You have the average operating assets. How much your return on investment here? Obviously, that will be 260 divided by 2 million. So my return on investment here as a percentage is 13%, where in this project, 460 divided by 4 million, my return on investment is 12%, or 11. So let's make it worse, 11.5. So where should I invest? Which project should I continue?
Project 1.
Project 1 now. Yes, clearly. Why? Because it give me higher return on investment. Now, even though residual income in both cases is the same, in both cases I'm getting $60,000 more than what I want. The first one, I'm generating more return on investment. So for some reason, you might see it even this. You might see it, just to trick you a little bit, you may even see that the second project generates $470,000. So now the second one generates more residual income. Would you go with the second one?
No,
No. Why?
because we are getting less return.
Less return on investment. How about if the second one generates $480,000? Are you gonna go now? You having $20,000 more residual income. Would you still gonna go with two?
No,
No. Make sense? Okay. So that's what I wanted you to see, that having more residual income, it doesn't mean you're getting higher return on investment. So for that reason, this is one of the, how can I say, negative sides of the return on investment. With the return on investment, you cannot compare investments with the different size. You can only compare if you're using the residual income. You cannot compare investment with different size. They have to be in the same size. If you're going with that, with a different size, then you're going with return on investment. If you're comparing apple to apple, go with residual income. That's the thing that the slides wants to tell you. I know it's kind of confusing, but that's the bottom part. So tell me, what do you think about this?
C.
D.
Professor is showing in the next screen, option C.
I know, but I wanted to see if you can see it. It is option C. Now, why is option C? Because again, return on investment and residual income, we're using it for only one purpose, to evaluating performance of the investment centers. We're evaluating performance of the managers for the investment centers. Nothing more. One indicator is return on investment for the evaluation of the managers. The other indicators is residual income. Again, we evaluating investment performance and how the managers using the money of the company to bring more profit. That's the only reason. So let's do this question. Now you cannot see the answer, but we can copy this information. Let's copy the information. I'm gonna open Excel spreadsheet. Just give me a second. And we can work with this information so we can get something out of it. Just give me a second, please. Trying to see how exactly I'm gonna use it so it can be more appealing. Okay, so I have the question. Just give me a second. I'm gonna flip it to you. All right. Stop sharing this one and let's share the new screen with Excel and let's solve this program. So this company has the following information. We have contribution margin, controllable margin, operating income, average operating asset, minimum rate of return. How much is the return on investment and residual income division, respectively? Contribution margin is good thing. Controllable margin is better. Operating income is that much. We're only evaluating the division. We're not evaluating the company. So the question is, which one of those three we're gonna use? Because we have three things that we can use here. Which one will be directly related to that particular division? What do you think? We're wasting too much time here. We won't have time for the assignment questions. So if you want we to go faster here, give me some ideas and let's move on.
The operating income?
Operating income, that will be company income. Are we evaluating company or are we evaluating the division?
Contribution margin.
Controllable margin.
Controllable margin will be more appropriate. Why? Because this division can control this margin. Everything else, the contribution margin is contribution margin sales minus variable cost. Do I have all the costs? No. I still want the fixed cost. Which fixed cost? Controllable fixed cost. Once I deduct controllable fixed cost, I'm gonna have controllable margin. Operating income when we're adding all the common costs for the company. Make sense? So for
Yeah.
those questions, using controllable margin, that's where we are. So what will be the return on investment? Let's get the formula and let's flip it here and tell me what's the return on investment. Quickly, please. Do we have that information now? Obviously will be this one divided by that one.
Average of
How much will be that?
90.
Let's put it as a
19%.
percentage. 1906. So now let's get the residual income. First, how much we want? I can usually use this thing here. So let's flip it here. And you start telling me what I need and what I have and what I need. Do I have my average operating assets?
Yes.
Yes.
Do I have my minimum required, how much the operating assets? 3,200,000. How much I
Yes.
want? How much they want? 12.5%. So they want 400,000. Correct? How much they generating? Controllable margin. How much the actual controllable margin?
610.
610. How much my residual income?
210.
210. Can you see it?
Yes.
Okay, so that's what it is. Make sense?
Yes, Professor.
Okay, good. Now let's move to the, and that's about it. I believe that's the end of the slides. Let's see if that's actually true. So this is the actual our correct answer, and yes, that's the end of the slides. All right, slides are over, people. So now what we're gonna do now? Okay, this company expect to produce that many units of production in 2020. Monthly production is expected to range from 374,300 to that many units. Budget variable manufacturing cost per unit as follows: direct material, direct labor, overhead. Budget fixed manufacturing overhead per unit for Depreciation $6 and $1. Prepare flexible manufacturing budget for the relevant range using the incremental of 15,400 units. All right. So what we're doing? What's our starting point here? Obviously, you're way better than me because you actually have a template, right? I don't have it. So what we have first, units. So how many budgets we have to prepare? We have to prepare one, and let's see how it is. What's the starting point? 74,300. That's definitely we have to have that number, correct?
Yes.
Let's format this here, those cells, because format cells, numbers. Let's use the currency with dollars, decimal place. No, we don't need. Like this. No, that's units, right? That's not a dollar amount. Wrong formatting here. It should be like that. Second budget and third budget. What's our incremental? 15,400, right? That's how much we're increasing. Make sense?
Yes.
So second one will be this one plus that one. Next one will be equal to this one plus that one. Do we have 74,300, 89,700, and last one 15,100? So we are in the same reality, correct? This is one, this is number two, and this is number three. Let's make it different colors so you can see it. Yeah, easy. So far, so good, right? This is our
Yes,
cells,
Baba.
right? This is our cells. What else we have to do now? We have to calculate the cost. Those are the units that we're producing. What's the first cost? We can clearly see that they're breaking the cost on two sections.
Yes.
What's the first one? Variable manufacturing cost. Let's put here variable manufacturing cost. What's the second section? Fixed
It's a fixed
manufacturing. Fixed manufacturing cost. Let's put it here somewhere. Hope that will be enough. Make it presentable. Okay, what's the first variable cost?
percent material for.
Direct material. Can you see it? Direct material.
Yes.
What's the second one? Direct
Direct
labor.
labor.
Third one,
Direct labor.
manufacturing
Overhead.
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 And then we're gonna have total, right?
Yes.
Okay. Per unit. Let's say here units. Unit. That's how much it increases. Okay. Let's leave one space here. Per unit, how much cost per unit?
4,
Or
$4. Here,
6.
6. Here,
12.
11.
11. How much is my total product cost?
21.
21. Now, what if I produce 74,300? How much will be my total cost? This one time $4, right?
Yes.
How about next one? This one time $6.
6.
Next one, 74 time $11.
21.
How much my total cost now? Did you get variable cost? Yes. So what we have to do, same thing. This one time that one Now I can flip the formulas, but that's going to change the covers, but I'm going to fix the covers later. No, it doesn't work this way. Why it doesn't work? Because I have to lock this cell, B11. Then I'm going to lock this one, B11. Am I locking that one? Yeah, let's try this one, this way, if this is going to work. B11. So if I flip the formula like this, it should work. Now, the only thing that I have to do is change the cover. And now I'm good. So how much is my total cost for all those periods? I have it. Make sense?
Yes.
All right. So we get first thing. If you want to do it, you can do it like this. And for the total cost, you can make it highlighted to do it like this, and then it's going to be thicker. So we get the total variable cost. What's the next thing that we have to get?
Depreciation.
Well, we have to get the rest of the cost, right? Fixed manufacturing overhead cost. Which other one? Depreciation. And what's the other one?
Supervision.
Supervision. So now the question is, do you remember what we did for that cost when we're doing the question in the class for the slides, from the slides? Do you remember what we did in the class once we had exactly the same question in the class from the slides? What we did? Obviously, we read the question. And what the question says, this company is expected to produce that many units. When? When they're going to produce those many units? 1,260,000 units. When they're going to produce those ones? What's the period? For which period they're going to, for how long they're going to produce this many units? Or how, sorry?
22.
In 2022. For 1 year. Make sense? Does that make sense?
Yes.
What kind of budget we have to
Yes,
prepare?
Professor.
What kind of budget we have to prepare? Those units that we're doing here, on what for what time frame they are? How long is it going to take us to produce 74 or 89 or 105?
A
It
month.
says
That's a monthly.
monthly. Okay. So what we have to do? Do I have my total production for the entire year?
Yes.
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 Do I have my depreciation cost
Yes.
per unit? How much is it? $6.
6.
How much is my cost for the entire year?
Done.
That's one time $6. How much is per month? If this is for 1 year and I have to do for a month, how much is my monthly cost? Is that what you're getting?
Yes.
Okay, that's your depreciation. What do we have to do with the supervision salary? Exactly the same. Only we're going to change it here with the supervision. What's my... I know how many units I'm going to produce for the entire year. How much my cost per month
One.
in total $1 per unit. That's gonna give me. I have to pay this person. Oh, that's a lot. Supervision, I have to spend 1,260,000. How much per month?
1,200.
105. So, where's my depreciation? This one is my depreciation. Where's my supervision? That's my supervision. How this gonna change month to month? No, sorry, wrong question. How this gonna change if I change the unit of production?
They will remain the same.
They will remain the same. And same thing here. So how much my total fixed cost? I can count
736.
730 all the way across the.
737.
Make sense?
Yes.
So how much is my total cost?
The total variable cost plus total fixed cost.
Total variable cost plus total fixed cost. So the total manufacturing cost, because we have to do the manufacturing budget, total it will be equal to this number plus that number. Let's highlight those two numbers so they can be very obvious for you. And you're getting the total calculation. Is that how you did it? Hmm? That's how you did it, right?
Yes.
Or you, good. If that's how you did it, that's the way it should be done. And as you can see, that we're using exactly the same approach that we use in the classroom. We did exactly the same thing in the classroom, if you remember. That's your question. Let's see what else, what other questions we can get from here. What's the other question that give you so much trouble? Do a preview question. Variances, how much trouble the variances give you? The variances, did they give you trouble or no?
The direct material and labor? Yes, at least for me.
At least for you? Okay. Can you still see my screen? Yes, you can. Let's see what's happening with you. This one. Hmm. But this one, so we can see it. Okay, so standard cost for the product included 2 units of direct material, $5, $5.60 per unit. During the company bought 27 units of material, 580, and used the materials to produce 14,000 units. Calculate the total price and quantity variance for the material. So now, we don't have much time. We don't have much time here, people. Anyway, I'm going to give you something very quick. What we're chasing here is actual cost versus the standard cost. That's what we're doing. On the one side, we're going to have the actual cost, and on the other side, we're going to have standard cost. That will be cost. And for the material, in order to get the actual cost, we need the actual quantity times the actual price. And that's how we're going to get the actual cost. Now, the actual cost, we're not given to us, but we know how many units we actually bought. We bought 27,000 units. Can you see that?
Yes.
And we paid $5.80. Can you see that?
Yes.
Based on our standards, if we buy, based on our standards, standard quantity, no, that will be, here we're going to have standard cost will be standard quantity time standard price. We have our standard price, correct? Our standard price is $5.60. Can you see it?
Yes.
Right. But in reality, here, and here I'm going to make something in the middle side, we're going to have here actual quantity and time standard price. Sorry. Time standard price. In reality, we bought 27,000 units, correct? That's how much we bought. And if we buy 27,000 units based on our standards, how much we supposed to pay? Here, based on our standards, how much we supposed to pay per unit? $5.60, correct? Make sense? Those are our standards. Our standard says that if you buy this product, you should pay $5.60 per unit. In reality, we bought 27,000 units, and we paid $5.80 per kilogram. Do we have a variance here?
Yes.
Yes. Now, how much is our actual cost now? Actual cost is 27 times 5.8. This is my actual cost. Based on my standards, using my standard price, how much is supposed to pay? I'm supposed to pay $51,200. Do we have a variance because of the price? Are those two numbers different?
Yes.
That means we have a variance. How much the difference is? This one minus that one. I have $5,400 difference. Is that favorable or unfavorable for me?
Unfavorable.
Unfavorable. Why? Because when I buy $27,000, 27,000 units, I supposed to spend $5.60. In reality, I'm spending $5.80. So I'm paying 20 cents more over how many units? I have 27,000. I'm buying 27,000 units. And I'm paying 580 minus 560. So I'm paying 20 cents more. Because of that, I'm having this $5,400 variance. Make sense? That should be the appropriate here. Do you understand this logic?
Yes.
Okay, so now let's see with production, what's happened with production. Now, in reality, let's get this numbers. When it comes to production, my standards, again, my standards are I have to pay $5.60 per unit. That's my standard price. Make sense? It says here in the question, $5.60 per unit. That's my standard. And for every unit that I'm producing, I have to use 2 units of direct materials. Now, how many units I produced? How much is my production?
14,000.
14,000 units. If I want to produce 14,000 units, how much materials I have to use based on my standards?
28,000 units.
Time, I have to two units of material I have to use, right? So that will be equal to 14,000 times 2. So I need 28,000 units of materials. So here I have 28,000. Make sense? In reality, how many I used?
27,000.
I bought and used 27. Am I using more or am I using less?
Less.
Less. So what will be my number here? Well, the number will be the same, 51,200. This one time that one. 51,200, no questions about it. That's how much I spent in the, that's how much I'm paying when, based on my standards, when I'm using the materials that I bought. Based on my standards, I supposed to spend how much? $56,800. What kind of variance I have here? First, do I have a variance or no?
Yes.
Yes. How much is my variance? $5,600. Is that favorable or unfavorable for me?
Favorable.
Favorable. Why? Because I'm supposed to spend $56,800, but I'm spending $51,200 only. That will be favorable here. Now, watch this. Based on my standards, I'm supposed to spend $56,800. But my actual cost is $56,600. Do I have variance?
Yes.
How much is that variance?
200.
200. Is that favorable or unfavorable?
Favorable.
Favorable. Why? Because based on my standards, to produce 14,000 units, I'm supposed to use 28,000 units of material, and I have to spend 560 per one material. In reality, when I'm producing those $14,000 units production, I used 27,000 units of material, and my actual cost was $5.80 for materials. So in overall, I'm spending $200 less what I'm supposed to spend. Why? Because I'm using 1,000 units less materials. Because I'm using 1,000 units less materials, I'm saving $5,600. But I'm paying 20 cents more per unit. And because of the price increase, I'm losing $5,400. Now, my saving from the using less materials is more than the loss that I'm losing for the paying higher price for the material. So my overall variance is 200 favorable due to more efficiency that I have. So my price variance will be $5,400 unfavorable. My efficiency variance will be $5,600 favorable. And my overall variance will be, spending variance will be $200 favorable. Make sense?
Yes.
Okay. So now let's see another question of those. Yeah, those we never actually discussed those one. Standard price per liter. We'll leave this one to you. Standard. Irina, you said for the labor variance, right?
Yes.
What will be the, which question will be that? I'm trying to find some favorable. Labor, okay, hours. Standard labor cost, and yes, okay, got it. Okay, what we're gonna do is, I'm gonna use the same Excel spreadsheet. Now we're going over the time, but if you in a rush, you can go. If you wanna stay. I'm gonna use the same template. I'm just gonna do some modification. This company, ta-ta. And calculate. Okay. So now, again, we're facing actual versus standard, but now actual cost versus standard cost. All these things I can erase them because I don't need them. Now we're doing labor. For labor, I have to do some adjustments here. Labor is not measured by quantity, labor is measured by hours. So we're going to have actual hours. And labor is not measured by price, labor is measured by rate and have actual rate. Here I'm going to have actual hours, standard rate, and here I'm going to have standard hours, and then here I'm going to have standard rate. Now, let's look at the question and let's see which numbers we can extract here. First, this company have a standard for unit of output. For every unit of output, they spending 2 hours. And for every hour, they spending $10 per hour. What's my standard rate per hour? Base my standards. How much I'm spending per 1 hour work? Talk to me, people.
$10.
$10. My standard rate is $10. Now, but I'm using 2 hours to produce one product. Can you see it?
Yes.
Okay. During August, how many hours my workers work? Actually work?
2100.
2,100 hours. That's my actual hours. And that's 2,100 actual hours. So here I have a number, right? What's my number here? This one time $10. So if once my worker work 2,100 hours, based on my standards, how much I supposed to pay them?
21,000.
$21,000. So if my workers work 2,100 hours, based on my standards, I supposed to pay them $21,000. In reality, how much I pay them?
29.80.
So how much is the per hour? How much I pay them per hour? $9.80. So in total, how much total I pay them? That much. Is that good for me or bad for me? Do I have a variance first?
Yeah.
Yes.
How much is my variance?
420.
This one minus that one. 420. Is that favorable or unfavorable for me?
That's favorable.
Favorable. Why favorable? Because I supposed to spend $21,000 if they work 2,100 hours. In reality, I spent $20,580. Why? Because I paid them 20 cents less. So because I paid them 20 cents less, so my calculation here will be 2,100 hours time 0.20 cents. Is that gonna give me $420? It should, right? That's why I pay them $420 less, because I'm paying them 20 cents less per hour. Over 2,100 hours, that's $420. Now let's see, based on my standards, how many products I produce. Here, how many products I produce? How much is my production?
1,000.
My production is 1,000 units, correct? Now, if I have to produce 1,000 units based on my standards, how many hours I need per product, per unit?
2.
2 hours. So in total, how many hours I need based on my standards to produce those 2,000 units?
2,000.
2,000 hours. So my standard hours to do the actual production of 1,000 units is 2,000 hours. Can you see it?
Yes.
Yes. So if I have to produce 1,000 units, based on my standards, how much I supposed to spend in total for labor?
20,000.
$20,000. How much I spending?
20,580.
First, let's see, is there any variance between the amount that's supposed to spend at hours to produce 1,000 and the amount that they're actually spending per hour to produce those 1,000 units? Is there any variance here?
Yeah, 100.
Yes, that's $1,000 variance, right? Right there. This one minus that one. $1,000 variance. Is that favorable or unfavorable now?
Unfavorable.
Unfavorable.
Unfavorable, right? Because I'm overspending.
Hmm.
So let's insert some rows here, push those one down. So why is unfavorable again? Because I'm using the $10 is my cost, $10, but I have increase in hours with $1,000. Sorry, 100 hours. 100 hours increase. And that's how I'm getting $1,000. You see, 100 hours increase. Based on my standard, I'm supposed to spend 2,000 hours. In reality, I'm spending 2,100 hours. And since based on my standard, I'm paying them only $10, my efficiency is less. So I'm using more hours. In total, when we drag this number, compare standard cost versus the actual cost, do I have variance?
Yes.
What's my variance?
580.
This one minus that one. Is that favorable or unfavorable for me?
Unfavorable.
Unfavorable. Why? Because based on my standards, to produce 1,000 units, I supposed to spend $20,000. In reality, I'm spending $20,508 to produce those 1,000 units. So I have overspending of $580. So this is the overall spending here. This is the saving that you're generating based on the decrease of the standard rate that you're paying your people. And this is the increase in cost due to the more hours that you workers work. Do you understand now those variances for the hours? Does that make sense?
Yes, sir.
Okay. Is that how you did it on your assignments? Those of you who did it?
Yes.
Okay. And there's a one manufacturing overhead variance here. Do you want me to go over that one quickly?
Yes, Professor.
Okay. Let's do this quickly. Variances is tricky thing, and since we're not going that deep in the variances, I understand why you won't be able to do it, but it's okay. I hope this explanation makes sense, and with the knowledge and understanding that you have on the managerial accounting, I know it's not with over this course we're not going too deep in the managerial accounting. We're just grasping here and there, but I hope that this explanation makes sense. Let me try this one. Make it bigger. All right. Okay, that's better. So in October, this company report 34,800 actual direct labor hours and incurred that many manufacturing overhead costs. So let's delete this one because I don't want this one to mess with your mind. So these people using for the overhead, to allocate the overhead, they're using the direct labor hours. Can you see that?
Yep.
So their actual cost, total cost, was $170,050. That was the actual cost. And for that cost, the workers actually work 34,800 hours. Make sense? Now, can I get my actual rate that they're applying to overhead?
Total cost divided by actual hours.
Direct total cost divided by the actual hours. So my rate will be that much. That's how much I actually pay them. Oh, no, sorry. That's how much actually the manufacturing overhead cost is. So this is the rate that I should have applied manufacturing overhead rate. Now, those are the actual hours, which coming from here. Now, what's my standard rate for the manufacturing overhead?
4.75.
4.75. That's my standard rate. And that's my also standard rate. What are my standard hours to make the work, to complete the work? Based on my standards, how many hours I supposed to work?
35,900.
35,900.
35,900. So based on my standards, how much I supposed to spend? So do I have a variance between my standards and my actual cost at
Yes.
this level? Yes, I do have a variance, right?
Yes.
What's my variance?
475.
Is that favorable or unfavorable for me?
Favorable.
Favorable. So my total manufacturer overhead variance is that much. Now, if the question asks you, if somehow the question asks you from where that variance came from, then you can do one step here in the middle. You can calculate this cost here, this one time that one, and you can say now, sorry, we go this one minus that one, and this one will be equal to this one minus that one. And you can say $5,225 favorable variance come from the fact that I'm using less hours. How many less hours you using? 900 less hours. Can you see it? No, actually not 900, 1,100 hours less. Can you see? I'm using 1,100 hours less. So
Yes.
1,100 hours less. And how much I'm paying per hour? 4.75. Because of that, I'm generating saving of $5,225. But on the other hand, my manufacturing overhead rate increasing from 475 to 489. And because of that increase, here I'm generating what kind of variance? Favorable or unfavorable? What do you think? Favorable or unfavorable? Here's the variance. I'm supposed to spend 165, I'm spending 170.
Unfavorable.
Unfavorable. Why is unfavorable? Again, because on the 34,800 hours, I'm paying, what will be that? 13 cents more. So when I combine this favorable 5,225 plus 4,750 give me 475 favorable variance. And since the question asks you only for the total manufacturing overhead variance, your answer here will be, that's my total manufacturing overhead variance. End of the story. Make sense?
Yes.
Yes, Professor.
Great. So, anything else? Any other questions here that give you trouble? Let me go quickly. Those should be the only one that give you trouble. Now we went to material variance, we went to the labor variance, we went to the manufacturing overhead variance. That should be clear. What else? There's this question here. Let's do it very quickly, which is multiple choice question, but let's see what they doing here. Material price variance, materials. So we don't need this one. I don't need the manufacturing overhead. I need the material. So what I'm gonna do with those Excel spreadsheets, I'm gonna label it and I'm gonna give it to you, okay? I'm going to tell you which one is material, which one is labor, which one is manufacturing overhead, variance, everything. So let's see this question first. And oh, that's how we do it. Okay, have to do some adjustments here. Just give me a second to do some adjustments. Okay, so we have something here. Maybe, and then, okay, that should be straightforward now. Okay, and then, actually I need a little bit space here. Now I can flip that one over here. Give me exactly the same thing. Yeah. Copy. Let's do something else then. Let's paste them here as of values. Okay, we have the question. Now, can you see, guys, see the question?
Yes.
Okay, so I can get rid of all those things, so we don't need this. And let's start fresh. We're doing materials. So, standard, this company, manufacture cleaning detergent. Cleaning manufacturing is a weekly basis. The following standards have been established to produce 10,000 units. So we're producing 10,000 units. The standard direct material use is 10,000 liters of detergent. What's my standard quantity based on my standards?
10,000.
10,000. All right. Do we have first number? What's my standard direct material price?
4.
$4. No questions about it. And that's standard price moving right here. In reality, how many liters I actually use?
12.
12,000. At what price?
4.35.
$4.35 I actually paid. Now the question is, do I have the variances? Well, we have to calculate. What my standard cost should be to produce those 10,000 liters? 10,000 times 4, my actual cost should be 40,000. In reality, is that how much I'm spending? Yes or no?
No.
No. So what's my middle number here? 12,000 times 4. I have here 48,000. So what's happened now? Let's think about it for a second. What's my variance first here? Between the standard cost and the actual quantity times standard price. I have here $8,000, favorable or unfavorable? If I suppose unfavorable. And here I'm gonna have what? Another variance, which is favorable or unfavorable? How about spending? I'm supposed to spend 40,000. I'm spending 52,200. How much is my total material budget variance?
12,000.
12,200. Why? Because first you're using more materials, and because you're using more materials, that drag you with $8,000. 2,000 liters times $4, that's $8,000. And then because you're paying 35 cents more on the 12,000 units. So 35 cents times 12,000, that's $4,200. In overall, you have variance of total budget, total material, direct material budget variance, in this case, is equal to 12,200. What will be that? Favorable or unfavorable now?
Unfavorable.
Unfavorable. You won't be able to get favorable when you have, on this level, you have two unfavorables. They're just adding together. And that's that's the last question that I wanted you to see. Anything else? I think that's all. I think that's all, guys. I think now you're okay. Be careful with these standards and actual. Be careful, read the question carefully. Now, when you have these charts, I'm gonna post you the charts right away. Once you have the charts, you can use those one for your questions. Let me label these charts in front of you so you can see what is it. So where we started, starting with the return on investment. Then what we did, return on investment with the return on investment first part, moving to target margin in turnover. That's a return on investment question. And then we're moving to residual. That's still return on investment question 2. That's question 1 here. Question 1, that was return on investment question 2. Return on investment question 2. Then we move to residual income. And then we make this residual income question 1. Then we move to budget. That will be flexible budget, right? Flexible budget. Then we move to the direct material variance. Then we move to the direct labor variance. Then we did manufacturing overhead. No, that's direct labor. That's standard output. That's direct labor. That will be manufacturing overhead variance. Then we did this question for the direct material again. Direct material variance. And there's nothing. Okay, that direct material variance question 2. And this is no, this one I use it for the formatting purposes, so I can delete this one. Okay, so you have the Excel spreadsheet. I'm gonna save it here on my computer and gonna post it for you. I'm gonna show you where I'm posting it, so you can go ahead and do it. I'm gonna save it. No, that will be week 10, right? 10 Excel. Save. All right, so let me share my screen and you can see where I'm posting it and you're good to go. All right, on the content, and I'm gonna post it here somewhere. On the budgetary control, and that will be learning material. You already have one Excel, and then that will be the second Excel that you're gonna have. Boom, you have it where week 4 Excel. Should be week 10 Excel. Did I download? Just a second, let me see. If I permanently delete. Let me see if I'm downloading the right one. Yeah, why I label it week 4 where that's clearly week 10. Week 10. Sorry, wrong labeling. Let me see what you're seeing. Yeah, you see everything that I'm seeing. And that will be your loading files. And you have it here, week 10 Excel, you have it as a spreadsheet. Also, you have 2 other Excels, pretty much. That probably will be the same thing that will be related to the recording from last semester. And this recording is going to be available for you as well. Questions?